Hey, Jeremy Surier here from Mansard. So today we're going to spend a little extra time talking about the greater Boston commercial real estate sales trends to watch. That's a mouthful. But what we're going to do is I'm going to drill into some of the interest rate information and how that's factoring into the office, industrial, and retail investment sales climate throughout the greater Boston area. So I hope you enjoy the video, and if you do, comment and hit the subscribe button. Thanks. Let's go. So our greater Boston commercial real estate sales trends to watch, Q2 2022, how's the market? This is Jeremy Surier here with Mansard. Happy to be with you today. I'm going to walk you through the latest sales data on our market for the greater Boston area, focusing specifically on three counties: Rockingham, Essex, and Middlesex counties north of Boston. I track asset sales from $1 to $100 million for office, retail, industrial, and flex property. So looking at the market by sales volume, you'll see here that 2021 was a hyperactive year. 2022 is moving along here, and based on our 2022 annualized numbers, we are expecting to see a year right around 600 transactions. Last year, there were 839 sales, and you'll see that that's really an aberration for the overall market cycle going back to 2006. Looking at that long-term average, you'll see that the market on average is trading about 439 deals per year. So last year was hyperactive. We're expecting 2022 to be an above average year based on our activity. So right now we're about halfway through the year. We are seeing some headwinds in terms of interest rates moving fairly quickly. War in Ukraine, inflation concerns, oil prices are high. So these are some of those headwinds we're facing in the market. It's possible that those could dampen down that annualized volume this year, but we are anticipating, with the stock market being so uncertain, that traditionally and historically capital starts to move into quote-unquote safer assets with less volatility, such as investment real estate. So in terms of volume and year-over-year effective change, we are seeing a slowdown. So this is the year-over-year compared to last year. Just looking at 2020 to 2021, you'll see there was a big jump. And that was that jump up to 839 sales last year. Coming down off of that, we're seeing a deceleration in the market, still trending above the long-term average, but we are seeing, I would say, a return to more of a balanced market environment. The 10-year Treasury's been making a lot of news lately. It's been on a downward trend, since 1990, and you can see here that we bottomed out in 2020, and our average yield on the 10-year is now at about 2.46%, and it's heading upward. At the time of this video, it's trading in the mid threes. So we are seeing an upward trend, and the reason why we look at the 10-year Treasury is because this is generally considered to be a safe rate investment. If you're buying a 10-year, you're not managing real estate, you're not facing capital expenditure costs, you're not facing vacancy, turnover with tenants. Those risks are not built into this return, so it would be expected for your real estate to be generating an above 10-year Treasury rate yield. So the question becomes, as interest rates move and we start to look at the cost of borrowed funds or debt capital to finance deals, what does that mean for valuation? Well, let's look at a representative scenario here. Let's assume that we have a property generating $1,350,000 a year in revenue. So that's potential rental income. The property either has vacancy or it doesn't. We're just going to assume in this case there's no vacancy on the property, but it's costing ownership about $350,000 a year in annual operating expenses, real estate taxes, so on and so forth. You go to the bank and the bank is willing to finance you at 25 years with an interest rate, let's say a year ago, we were looking at about 4%, at a loan to value of, well, we'll say 70%. And you were looking for a cash on cash return of at least 8%. Fair to say that deal would have traded at a 6.83 cap. With this scenario, $1 million NOI, 8% cash on cash return, valuation $14,633,084. Now, what happens when we move the interest rate up and increase our cost of borrowed funds? So if we just move it 100 basis points from 4 to 5%, and I'm going to leave the amortization period at 25 years, loan to value at 70%, and maintain the 8% cash on cash return. Let's just watch the estimated value box here when I hit enter. That deal now is repriced at $13.678 million at a cap rate of 7.31%, still producing that 8% cash on cash return. So that's the impact of the cost of borrowed funds going up. Now they go up some more. We hit a 5.5% rate in the market. Watch that estimated value. Okay, 13.230. So that's about a 10% swing to the negative in valuation, just keeping the loan parameters the same LTV. Rents have not gone up, and we have a cash on cash return staying at 8%. So we're likely to see sellers that are going to hold on numbers, and if buyers want the deal, they're going to have to come in and probably sacrifice on their cash on cash return requirement. So let's say they just give up 200 basis points or go for a 6% cash on cash return. You can see that value start to bounce back up into a range that a seller is going to be interested in based on their recent memory of value. So we can see here the transition that can happen in the market. The buyer is going to have to give on a cash on cash return. Lenders may need to be more competitive. You might start seeing some interest-only financing in the market, or even 30-year amortizations in the market. So bumping this up to 30-year at an 8%. Still is kind of protecting valuation. We're off by about 600, 700 grand. Or we may need to see inflation in rent. So that 1,350, even bumping it up to 1.4, not 14 million, but 1.4, you can see here we're supporting the valuation, but our cap rate is higher. So expecting to see some moving pieces here, some upward pressure on rents in any sector where we have low supply of available space. Looking to see buyers maybe making concessions on cash returns, as well as sellers maybe making concessions on some valuation, just to get these numbers to all fall in together. They're not all, it's not going to be the same across all deals in the market. They'll all be unique, but understanding that each of these components is going to be at play for determining value is going to make this market a little more dynamic. Still opportunity to make money, just being a little more sophisticated in how you look at the valuation of each of these asset classes that we're seeing today. So that's one of the reasons why we look at this, to see what the floor in the market is doing, and is a component of what the overall risk-free rate is. So looking back over 2006 to 2021, again, long-term average trading at 439 annual transactions. Average volume in a year is $2.7 billion across this market. Last year, 839 transactions with $6.7 billion in volume. From $1 to $100 million. You'll see here that overall the market is faring reasonably well. I mean, we're seeing appreciation still in the flex sector. retail, industrial, and office sectors. So our local Greater Boston market seems to be faring quite well year to date on sales value by average per square foot. When we compare that to the rest of the country, Green Street has just published nationally that they're beginning to see cracks in the market just in terms of the beginning of a rollover in value nationally. And then looking at the CREPI composite index produced by the CCIM Institute, their composite index here is also showing signs of a rollover in the market. So what's interesting is nationally starting to see signs of deceleration in the market. We are seeing volume. It looks like it's starting to decelerate when compared to last year, but still higher than the long-term average. Our average price per square foot valuations across these asset classes are continuing to appreciate. Retail-wise, you can see here our volume still holding a healthy trajectory, looking to the end of the year like we may end up around a 2017 or 2020 type year by volume. And then pricing here as well, also holding its own. Monitor, and what we like about this is that his data typically correlates pretty well to what we're seeing in the Boston area, and he's forecasting retail for the Boston MSA to actually be at a very strong position in the next 3 quarters. So heading into 2023 first quarter, he's anticipating that the market will do well. We'll see continued price appreciation and rental growth. How about the industrial market? Well, the industrial market continues to show signs of strong pricing power across the market, still holding strong valuations. We are seeing the volume of deals trading still healthy, but starting to look a little bit more like a 2020, maybe a 2018 type year, 2018-19. So we are anticipating that market starting to decelerate somewhat, which could be a function partially of owners not wanting to sell these assets and holding them for continued appreciation. It may also just be the pricing that we're seeing in the market in relationship to rising interest rates and buyers' ability to pay those prices to finance these deals. So any number of those factors could be combining in here to lead to a slowdown in the industrial sales volume. In terms of the forecast going out to the first quarter of 2023, again, Dr. Glenn Mueller's forecasting industrial to maintain a strong and healthy position, the peak of the market cycle, continued appreciation, and rent growth. The office sector, we're seeing volume actually maintain a pretty healthy pricing. In fact, we saw this dip in value. The first quarter 2020 started off very strong in office, but then as expected during a pandemic, we saw the average price per square foot drop off somewhat. We also saw some office product being purchased for redevelopment into warehouse and distribution facilities. So that market did go through some adjustments in 2020 and into 2021, but we saw a recovery begin, and we're actually seeing some price appreciation again in 2022. And what's interesting here is the volume of deals for office looking like a 2016 to 2018 type year. So expecting to see some healthy office trades this year as tenants are getting back to work. The latest data I saw yesterday was a report that 44% of tenants are back in the office. So starting to see a return to office trend here building, as well as some investor confidence in the market for an opportunity there. Forecasting office, Dr. Glenn Mueller is saying that in the next 3 quarters, we should expect to see office coming into the late recovery, early expansion phase in the market. This is characterized mainly by vacancies are no longer building. We're starting to see stabilization in the market. We're seeing a stabilized occupancy rate, rents, and valuations. So The office market's interesting. We could see some early expansion signs in the next year, depending on companies' decisions on committing to office and what their employment decisions look like. But definitely some opportunity here in this sector. So overall, we're happy to chat more about your specific market questions. There's nothing like sitting down and really talking about what your property is doing in the market today. So we're happy to hold a consultation with you, a complimentary discovery session. And in that session, we learn about your asset and what you'd like to do with it. And then we go in and talk about how we would expose your property to the market, bring the right buyer to pay you the right price, so then you could close with confidence. And with our continuous marketing process for selling investment property, 88.9% of our deals close on time at the seller's accepted offer price. It means that there's less hassle, lower stress, and frankly more celebrating, knowing that you've executed a sale that was successful and took into account all of the moving market dynamics you're seeing today. So again, if you like the video, hit the subscribe button, hit that notification bell. We update these regularly. Like to keep you informed on what's happening in the market. And feel free to check us out at mansardcre.com. We've got some free reports available there for download, and look forward to seeing you in the next video. Thanks.